Hello. Hi, everyone. My name is Brad Renard. Thank you for joining me for this webinar. And the name of this presentation is Broad Market Update. Let's look at the charts, the indices, the ETFs, stock charts, along with the economic data, and then I'll talk more about the Pinnacle strategy, which is a non-directional trading strategy. So if you could, someone just through the question pane, just let me know if you can hear me. Here, let's see. Okay. I'm still wondering if you guys can hear me. So someone actually through the questions or through chat, just say, hey, I can hear you. I'm just gonna say, can you hear me? I can hear you, good, okay, excellent. Excellent, excellent. Okay, at any time, if you guys have questions, just through the chat or question pane, I have that open so I can see it. Okay, and I'm assuming you can see my slides. So you should see the next slide. It says questions to address. So if you can't see that slide, then send me a quick chat on that. Okay, so here's what we're going to talk about. So the Qs and the NASDAQ composite indexes, they're at all-time highs. Small caps and mid caps are starting to show some strength. How's this influencing the rest of the market? S&P 500 index is trending upward, and it's now on target to hit its all-time high of 3388. So will it get there? Hold on for 1 second. I'm just doing a little bit of work on my desktop here. How expensive is this market? If this market sells off again, how low can it go, and where will it find support? What will be the best investment strategies for the balance of 2020? Basically, either passive buying of ETFs, stock picking, or an options trading strategy, kind of like Pinnacle. Should I sell some of my passive ETFs and stocks as this market trends higher? Should I add short exposure to my portfolio? Should I buy defensive stocks or ETFs? And then I'll give an overview of the Pinnacle strategy and I'll analyze a past trade. Okay, so for me, I'm more of a high-tech guy. I was an electrical engineer. I started at GE Aerospace Division. That was in the Northeast in New Jersey. Then I moved into marketing sales, VP of sales, co-founder of an internet company. I was in Japan for a while. My education is in physics, electrical engineering from Columbia, MBA from Chicago Booth. I'm also an adjunct professor at 2 universities here in Orange County, Southern California, Chapman University at the Agros School of Business and Economics, University of Redlands School of Business. My area of focus is management science and statistics, economics, and analytics. I'm also chief publisher of Upside Options, and I'm chief investment officer for QTR Capital Management. So for Pinnacle, okay, I have about 5 minutes of just kind of what we do, what the firm does, and then I'll jump into all the charts and the indexes and kind of my predictions and thoughts of what I see with this market. So if you can just bear with me just for 5 minutes, I can do this pretty quickly. So for Pinnacle, here are the returns. This is offered through Upside Options, actually will be offered through QTR Capital Management. QTR Capital Management is for larger accounts and institutions. So once someone exceeds the thresholds of Upside Options, which is usually about 125K, then we'll ask them to move over to QTR Capital. So Pinnacle is finally back to normal. We had 4 months of navigating through high volatility from the crash, from the COVID crash. So finally in June, got things stabilized, adjusted out of most of the trades. July booked a nice gain of 13.8%. August, we'll see what happens, but looks like the gain should be pretty nice now because we have elevated volatility, and that's actually good for the strategy. So I'll talk more about that. But we're finally in positive territory and we lost about 4 months from that COVID crash. So the strategies that we offer: big cap, small and mid cap growth, sector rotation. Now sector rotation is we're buying the strongest stocks within the strongest industry sectors. Contrarian, that one's when you buy stocks that are out of favor for 6 to 12 months and then they're starting to recover. Iron Condor Pinnacle, I'll cover more of that today. That's a non-directional, income-generating, conservative, all-weather, options-based strategy that typically generates 3 to 5%. I believe for the balance of 2020, I'll be generating more like 7 to 10%, maybe even a little higher. Volatility is still elevated, and that's pretty nice for this strategy. Then we have leveraged dividend income. We purchase a concentrated basket of high-quality dividend-paying stocks. We lever it up by 3 to 4 times, and then we open hedges to protect against most of the downside risk. So what's nice about this strategy is we do not need to predict the future direction of the market. So what it does is it focuses in and extracts out. So focuses on and extracts out the dividend. Target returns are 10 to 12% annually after commissions. And this is an optimum strategy to diversify a portfolio. So it's appropriate for a larger proportion of one's portfolio. Okay, so those are strategies that we offer. Our differentiation. So when it comes to the stock picking, stock strategies, we use 4-level quantum mental analysis. So we're blending technical, fundamental, factor-based quantitative analysis. We're also long short, where we try to get shorts in there, but it's not easy to do. And we try to put macro shorts in, where we'll buy puts on the SPY, and then we'll pay for those puts by selling really far out of the money call spreads, but not too many, just a very few, just to cover the puts. And it's a unique methodology, so it makes the short trades almost free. So it's never an easy process to put these macro hedges in place, but it's something that we're always thinking about, something that we'll do periodically, and it just helps with pullbacks and corrections. So we follow strict exit rules, so we're able to let most winners run, but the exit rules are fast enough to lock in gains and to protect capital. So for example, in late October 2018, we went from 75% allocated to 15% allocated in less than 6 days, because all of our stocks were exiting out. So we're just booking whatever profits we had because we follow very strict exit rules. And at that time, it worked out very nicely. We finished 2018 with all these positive gains for each of the portfolios, plus 18 to plus 25%. And back then, I don't know if you remember, that was in kind of the October, November, December 2018, the market just got hammered and all the benchmarks closed in with losses for that year, -8 to -12%. So that just demonstrates the power of following strict exit rules and following strict technicals on the exit rules. So for the 4-level scanner we use, we do a macro technical analysis. So at the macro level, big picture, kind of where the technicals, breadth, fundamentals, sentiment, and that modulates our bullish, bearish exposure levels. And then we do a technical scan to find high probability setups, usually looking at about 3,000, 3,500 stocks. Then we do a fundamental screen. We're looking for strong or weak companies, mostly strong companies for long positions. We're usually not buying puts on short positions. What we're doing is just macro puts, meaning on the broad indexes, we will hedge with the broad indexes. Then we do a quantitative screen, and that's using probabilistic models. And then finally, we use technicals to trigger our entries and exits. We're usually allocating 4 to 5% of the capital to each position. So again, these are for our stock strategies, the big cap, the small and mid cap, sector rotation, and contrarian. When we say factor-based quantitative analysis, just a quick summary of what that means. We use econometric statistical mathematics, and this provides predictions such as the probability that a stock will break up or down through a particular level, and the probability that a stock will move a particular magnitude up or down once it breaks through. So this usually requires several years of education in statistics, econometric mathematics, and along with 2 or 3 years of experience in developing models and optimizing models. And this is really the output from the model. This is an example. And we usually run this on 3,500 stocks. So this is nice for a final screen and gives us more confidence in selecting particular stocks. So that's what quantitative analysis means. Okay, snapshot of current market. So we had the COVID crash, and that was about -30 to -50%. that started in February 27th. And that was one of the fastest, deepest, and most violent crashes that I've personally seen in 25, 30 years. It was not helpful that the market was at an all-time high and was expensive when that happened. That was not helpful at all. So it just made it very painful where the crash was just deep and fast and violent. So most stocks have rebounded about 50 to 70%. Some have fully recovered and some have broken out to new highs. So the Qs, that's the NASDAQ 100. That's 100 of the large technology stocks. And the NASDAQ Composite that has about 3,300 stocks in it. So they're at new highs. The SPX now has been climbing recently, and it's on track to touch its all-time high in the next week or two. And that was 3388. The ultra cap stocks are at all-time highs, and that's what's really impacting and influencing this market. Apple, Microsoft, Amazon, for example, those three, Google, but especially the first three I just mentioned, their market caps are 1.3 trillion. I think Apple's heading into almost a $2 trillion market cap. And they have such a high weighting on these indexes that's part of the problem of why these indexes are just climbing so fast. Now, breadth has broadened, meaning what percentage of the stocks, of all stocks, are participating. So breadth is getting better, and I'll show a few of those charts. So buying stocks in March and April, that did well. We did that in the big cap strategy. Only focused on the largest, best, well-run companies because we didn't really know back then. I just wanted to only buy something that was around for 50 to 100 years and had a very low probability of going bankrupt. Most of those stocks are up 25 to 50%, and we already sold them. We were in, and then we're out pretty fast. So for the big cap strategy, we bought many stocks in March. And for the non-directional strategy, Pinnacle, which I'll talk more about, it's now back to normal. Finally, as of early June, our trades are sticking, and we're through that super high volatility, and we're bringing in higher levels of premium. So it's pretty nice right now. Okay, let's go ahead and look at the charts. Here's the NYSE. This has about 1,900 stocks in it, all on the New York Stock Exchange. This is a weekly chart. I show the 17-week, 43-week EMA. These are my favorite indicators, or at least moving averages when I look at a weekly chart. When the 17 is above the 43, it's telling you that there's a higher probability now that this market's going higher, or at least that index or stock is going higher. 17 is still below the 43, but it does look much better. The 17 is above this major level here. I'm sorry, the actual stock or the index is above this level here. So the NYSE is now finally looking better, but this is one of the ugliest charts I've ever seen. So it shows the crash took the NYSE all the way back down to 2016 levels. That was just a horrible crash, and it did that in 3-4 weeks, and it was down 40%. Ugly, really ugly chart. Here's the small caps. The small caps are improving just recently, and that's a big deal. So IWM follows the Russell 2000 index. These are all small caps, usually under 5 billion in market cap. And this one looks similar to the NYSE, just a very, very ugly chart. So I'm showing these two charts first because I'm showing how much damage was caused by the COVID crash, where it literally retested the 2016 lows. And that was horrible. So the small caps, mid caps are the last to really recover, and this is pretty typical. 17 EMA is still below the 43 weekly EMA. This is a weekly chart again, but it's looking much better in the last 2 weeks. So I'm starting to put more effort into the small and mid cap strategies now. Our stocks we've had a hold for 3.5, 4 months because most of them got hammered from the crash. We just held. Most of them are recovering now. We're starting to get out of them, and we're starting to get back to work. I'm seeing money flowing into the small caps now. All right, here's the S&P 500 index. This is the one we really care about. This is the major 500 large cap indexes. It is influenced by Apple and Microsoft and Google and Amazon. It is. So that doesn't help much because I think 25% of this market cap weighted index is those 4 stocks. So that's the sad part of this, but it is what it is, and the S&P 500 index is something we have to watch very closely, and it's a market cap weighted index, and it's finally stabilized. In the last 5 weeks, it was holding above this key level of 3,000, and it was telling me, all right, we're probably going higher now. Once it held and stabilized in the last 4 weeks, it definitely has been trending higher. 4 to 5 weeks, and now it's probably going to touch 33.88 sooner than I thought. I thought it could take another month or two to get up there, and nope, it's getting up there pretty fast. Here's the Dow. Don't look at the Dow too much. I mean, it's 30 stocks. It's price weighted, which is really archaic, but it's an index that some people look at, and I'm just going to bring it up here. This is the weekly chart. Here's 2016 lows. After the election, then we climbed, crashed down to almost those lows, and now we're getting up here trying to break up through this 27,300 level. So that's a key level, and it looks good. So that's a positive for the market. Volatility touched, I believe, almost 90. It was higher than the 2008 crash volatility that we saw in 2008, 2009. And it was fast and violent. So we're down to about 22.5 for VIX. This is volatility for the S&P 500 index. And some of the moving averages, you can see that the VIX is now below its 200-day line. That's a positive. You can see that the 50-day moving average is ready to cross through the 200. So it's just telling me that volatility is slowly declining, and stocks will continue to try to grind higher, even though they're very expensive. I'll talk about that in a minute of how expensive they are. And then bonds. Here's the 10-year note. People poured money into the 10-year note, and they pushed the yield down to 0.54%. Just tells you that, and money's still going in the bonds or staying in bonds. So that tells you something, that someone's going to be right. Which one's going to be right? The stock market, where everyone's pushing it up to almost 23 times earnings, or the bonds people are buying, 10-year notes and saying, no, I'm not touching the stock market, and they're keeping yields really low. So someone's going to be right, someone's going to be wrong. So here's earnings. And so this is time down here. The blue is the price of the S&P 500 index as a function of time. And the black is forward 4-quarter earnings for the S&P 500 companies. So there's 500 companies in the S&P 500. Each company throws off earnings every quarter. Like GE might throw off $2.25 of earnings. IBM might throw off, $4 of earnings. When you take all those earnings and add them all up, you'll get about $145 to $150 of earnings. That's looking out, and that's being predicted by the analysts 4 quarters. So forward earnings, we cut them to $145, and that was about right. I'm still sticking at $145, but the analysts are pushing it up a little bit. So the S&P 500 companies are now projecting to generate $145 of earnings over the next 4 quarters. And the market's trading at about 22.9 times earnings. So you basically take where the market's currently at, and we're at 34. Oh yeah, I'm sorry, I'm looking at the wrong side. We're over here, 3340. 3340, 3350, that's kind of where we're at for the S&P 500 index. Divide that by $145 and you get the market, the PE, price earnings ratio. So this market's very expensive. We're trading at 22.9 times earnings. That's incredibly expensive. Now the market is looking forward 6 to 9 months, trying to predict what's going to happen in 9 months, and then everyone places their bets. So everyone's placing their bets that earnings will rebound to get this PE ratio back down to something that's more normal. I mean, maybe 18 times, 19 times. That's still kind of expensive, but it'd be better than almost 23 times earnings. So market is pretty expensive, very expensive. Let's look at the economic data. So this was kind of easy to look at now because the market, the U.S. economy got so devastated that you don't even have to look at the data. You just know that the non-farm payrolls, we got 30 million people out of work, unemployment rate still at 12%. ISM index, now actually it did bounce back. This is interesting. So ISM, now this is a diffusion index, so I don't put too much weight into it, but the diffusion means that they send out a questionnaire to, a couple thousand businesses around the United States, and they say, so are things looking better or worse than they were last month? And so people will fill it out, but it's not based off of hard data. It's soft data. And people evidently are feeling more comfortable because we're back over 50. So this represents manufacturing activity around the United States. And if it's greater than 50, it's telling you that the people who fill out the forms and sent them back to the government are saying, yeah, we believe that we are going to be expanding our manufacturing, activity over the next month. So this is a little surprising that it bounced back so fast, but it's good. But unemployment rate still at 12%. We still got at least 30 million people out of work, and we'll see what happens. Here's GDP. So GDP, we contracted about 10%, about 30% annualized last quarter. But now we're the Atlanta Fed model. This is the Atlanta Fed GDP Now model. It's a pretty accurate model. Predicting that GDP will next quarter by 20%. So we'll see. Retail sales, got crushed, and now it's bouncing back. So people need to spend because that represents about 75% of our economy is people spending money. So we'll see. I mean, no one really knows, but we'll see what happens with the economic data. So all of it just got completely devastated, and the stock market is predicting that all of this data will be back to normal in the next 9 months. That's what it's predicting. So people are making their bets, they're piling in, pushing up stocks, and then people cross their fingers that they're right. Okay, let's look at worldwide charts. Europe, Germany, emerging markets, China, then the world ex-US. They're all looking pretty good. So the Europe, we're back over the 200-day line. Germany, we're back up to this level here. That's good. And Germany got the virus under control. Most of Europe has, at least a lot better than we have. Emerging markets, the dollar has weakened. This is good for emerging markets, and a lot of countries around the world, other than the U.S. and Brazil, seem to have figured out how to get the virus under control. China looks okay, and world less the U.S. And I'll talk more about kind of different investment ideas and stocks that you can get into, or ETFs you can get into, and FXI. This is one that you could jump into, and IEV. Actually, I don't show this one in my future slides, but this one here. Okay, let's look at the indexes. Now these are daily charts. I'm showing the 200-day line, 50-day line, 13-day line. 13 and 50 are EMAs, and this is a SMA, simple moving average. And then I always have my support and resistance lines. So if you have charts, make sure you always draw your support and resistance lines. And in general, when the 13 is above the 50, stock's probably going higher, or it's going to go up and retest a level up here. My thought over the last 3 months was that when a stock rebounded and got all the way back up to its highs, I wanted to sell it. And so that's what I did. I was not expecting these indexes to blast higher and take out new highs, not with 30 million people unemployed. So I'm not chasing these stocks. I'm not chasing these indexes. So I am very surprised that we got another 10, 15% gains, 20% gains on some of this stuff that have taken out new highs. So that's what the Qs have done. Qs is the NASDAQ 100 of the largest technology companies. And again, we got Apple in there, Microsoft, Google, and that represents, for this index, represents 35, almost 40% of the index is just 5 companies. So it's kind of crazy. It just makes these kind of worthless because there's just too much weighting in 5 stocks, 4 stocks. So that's the problem with these indexes. NASDAQ Composite, same problem. It's a lot of stocks, but Apple, can move this entire index. So Apple was up 2% again today, 1.5%, something like that, or more. And here's what it does to this index. Okay, so These broke out a long time ago, like a month and a half ago, 2 months ago. So that kind of tells you this market's probably going higher. S&P now it did come, got over its 200-day line, retested. This is healthy, and this is what needs to happen. Retested over this 3,025 line, and now it's taken out higher highs, which is not surprising at all. And this is what I've been stating in the Sunday advisory that I send out each week. And I mean, it's like, man, we're probably going up to 33.88. So the timing is difficult to know. It might take a couple of weeks. It might take a month or two. Well, it's going faster than I thought. And we have a jobs report tomorrow. So people are still piling into stocks ahead of a jobs report tomorrow. But I think also people are anticipating Congress to release the next coronavirus relief bill. And that will push more money into the economy, and it'll probably push these stocks up even higher. All right, for the Dow, this is daily chart, 13. Here's my 13 EMA, 50 EMA, 200 EMA, all my support and resistance levels, and we're getting over 27,300. So the Dow will probably break up through, and then one of these days, the Dow is going to be back up to 29,000. I just don't know when. Small caps, daily chart. This looks very healthy. Okay, so it got crushed, came all the way back down, retraced down to the 2016 levels, back over 144. This is impressive. So this is telling me to start spending more time on the small and mid caps and adding more positions. I'm going to probably rotate out of stuff that I got most of my money back, but I'm looking for fresh trades now, fresh positions with better technicals, and post-COVID crash. So small caps are looking much better. Here's the NYSE composite. We're over the 200-day line. Again, this is 3,300 stocks on the NYSE exchange, New York Stock Exchange. This is pretty darn healthy. For that thing to get back over its 200-day line, it tells me that this market probably wants to go higher. Not that I want to chase an Apple or a Google. Well, actually, Google looks okay, but an Apple, for example, or a Tesla, no way. Okay, market breadth. So this is cumulative advanced decline lines, and then I put some moving averages on it. Advanced decline means on a daily basis, you take, for example, this is the S&P 500. There's 500 stocks in this index. Every day, you look at the 500 stocks and you figure out how many advanced and how many declined. You subtract the advancers from the decliners, you get an integer, either positive or negative. Then you just keep on adding that integer day after day after day, and just call it a cumulative advanced decline line. It's a very good leading indicator. It's probably one of the few leading indicators out there. So you want to make sure you know how to use this thing and watch it. I show it each week on Sunday in the advisory. And by the way, that's free. You can go to the upsideoptions.net website. You can get the advisory and you can have it sent to you every Sunday. Make sure you look at that every week. And this tells me that this market's going higher. I mean, for the S&P 500, we're still climbing. We just took out a higher high. It's incredible strength. This is for the NASDAQ composite. That looks pretty good. And then look at this for the NYSE composite cumulative advanced decline line. Yikes, that's just incredible of how much money is flowing into stocks right now. So there's more advancers than decliners on a daily basis. That tells you that this market's going to go higher. And by the way, pre-COVID, literally mid-February, late February, just before the crash, we saw the exact same indicators. This market was not ready to go lower. It was going higher. And so it was telling me not to open up hedges. And in general, you do not want to open up hedges in February or March or April. A good way to get your face ripped off. I've seen that too many times over the last 25 years where you just never want to short the market in February. January, February, March, April, those are the strongest months of the year. Never a good idea to hedge. And then COVID hit. So it gets no worse than that. All right, corporate bonds, high yield looks fine. That means that investors who buy this high yield debt from companies feel comfortable with the quality of the company and feel comfortable that these companies won't go out of business and default on their debt. Investment grade debt is usually BBB or greater in quality of debt. And it looks like everyone's feeling comfortable. They're actually pouring into corporate grade debt. And I don't like that. I wouldn't be chasing it, but people are willing to take less and less of an interest rate to lend their money to companies. Okay, let's see if I have any questions here. Okay. I just got a warning on my system. It said I might have degraded audio. If anything is not working, just let me know. I can see the question pane here. Okay, market sectors. This tool is called ETF Replay, etfreplay.com. It's a pretty good tool. I use it. It's not that expensive, and it has a particular model that you can adjust, and it gives you the rankings of all the ETFs, all the sectors. So I got 85 sectors that I watch, and then these are the rankings, 1 through 20, and then 21 through 40. And anything in the top 25, 30 is pretty strong sector. So we can see, I just marked a few here: medical devices, home builders, here's semiconductors, in general technology, just general technology, mid-cap growth. So we can see the mid-caps and small caps. I got small cap growth here are doing well. Dynamic software, cybersecurity. So these are the symbols: HACK, PSJ, IJT. So these are just different ETFs that I follow. And then I'll especially use this for sector rotation, because for sector rotation, I'll take these top 20, 25 sectors and focus in on them and find the best stocks in these sectors. And those are the ones that we buy, and then we'll ride them. We'll ride them. They're more momentum plays, and we'll ride them until they stop working. Usually I can get 15 to 30% gain on those stocks before I get out of them. And then usually best just to get out of them and rotate into something else that's working. Okay, so I showed a lot of bullish stuff. Sorry. Yes, okay, here's the next slide. I showed a lot of bullish activity, and does this market want to go higher? Yes, it does. We'll see what happens tomorrow. We have the unemployment number comes out. I have no idea how the market's going to react to the unemployment number, but it's going to go either up or down. And I do care about that, because in Pinnacle, I got trades, I got calls, and I got puts. And so I need enough buffer in there, so when that unemployment number comes out, that I don't get hit on those trades. So now for defensive holdings, this just tells me that, it's like people don't like what they see in the stock market, and they're pouring into gold. Now the dollar is weakening, so that helps gold, that helps commodities. There's fear out there about what's going on, so people will pour into gold for that, and silver, and bonds, bottom left, TNX. So they're pouring in the bonds and pushing down the yield on the 10-year note. And XLP, these are consumer staples, and the Cloroxes and the Procter & Gambles of the world are in there, and it's at highs too. So it seems like anything that could go up goes up right now. So there's no correlation to anything. Someone's going to be wrong. All right, so either the stock market's going to get just so horribly expensive and finally have a pretty nasty 10% pullback, and it could pretty easily, or at least a 5%. But gold. Now, by the way, for gold, just a little trick for you. The best thing to do for stuff like this, if you want to buy gold for defensive purposes, is just watch a weekly chart in the 1743 EMA. And once the 17 dropped below the 43 here, and especially drop below this support level here, you want to be out. Simple as that. Absolutely get out. If you're buying like just GLD and GOLD, just gold stocks or ETFs. I mean, if you're buying coins, sure, you just hold them. You're holding them for a reason. But if you're more of buying it for an investment and as a hedge, when that 17 breaks below the 43 and you're dropped below a certain support level, get out. And you can see what happened. It dropped, 17 got below the 43, and it stayed below the 43 literally for 1, 2, 3 years, did nothing for another 2, 3 years. So you just don't want to be wasting, having your money locked up in something like this, other than just having gold coins sitting in the drawer or sitting in your safe, and that's fine. And then watch the 1743 and watch for breakouts. And then once the 17 breaks above the 43, and once you get up through a certain level, like this level here, then go long. Now, you just don't know what it's going to do. And if it starts breaking below this level again, you got to get out, because it failed. If it breaks below that breakout level, get out, because now it could go sideways again for another year or 2 or 3 and lock up your money. But if it breaks out and it stays above the breakout, stay long, and look at what just happened. You just made 40% on your money, 45% on your money in gold. Pretty amazing. Silver, you could probably still get in, but boy, you just don't know. You just don't know. It's probably going higher, and silver, it probably will touch these highs. It could, reasonable probability. Okay, so defensive holdings, that's some of them right there. Okay, let's look at some industry sectors. XLI, industrials. Industrials look good, back over its 200-day line. That's a positive. That's kind of a broad leading indicator for the stock market. So if industrials are up, that's a good thing. Banks are still depressed, and that's not a good thing. Usually the market will struggle to go higher if the banks aren't participating, but this time around, that's not the case. So the banks are still down below, way down here, bearish. XLY, consumer discretionary. Amazon, unfortunately, is a big piece of this index, so that's driving it higher. But overall, this is still good news. It's telling you that discretionary stocks are climbing, and these are things that people don't need. They don't need a jet ski. They don't need a pool table. That's consumer. They don't need to go to movies. They don't need to go to restaurants. I mean, these are all consumer discretionary items, and it's climbing. So that's a positive for the stock market. Equal weight technology, RYT, very strong. Look at this. And this is equal weight. XLK is a typical market cap weight technology index, and that thing's gone straight up. So I like to look at the equal weight as much as possible, and this is still strong. It's still telling me that technology stocks are looking good, and that's going to drive the entire market. Transports, pretty powerful. Leading indicator for the market. Tells us that if the transports are participating, then the overall stock market will be okay, and that's what I'm seeing right now. Finally, just in the last couple of days. Again, these are all daily charts now: 13 EMA, 50 EMA, 200 SMA. And SMH, semiconductors, for it to break out like this, wow, and that's a leading indicator for the overall broad market, so that's pretty powerful. Powerful indicator telling me that, okay, this market is grinding higher and I'm not going to fight it. I'm not going to fight this trend. Okay, let's look at some stocks, ETFs, and some of my ideas and thoughts about what you could put some money into. The first thing you want to look at when you're looking at individual stocks are just the ultra caps, the huge companies that have just been driving this market. And so Microsoft, Amazon, Apple, Facebook. So those are the ones that really can drive the overall market because they're all huge market caps. Apple, I think, is closing in on a $2 trillion market cap. So that you just want to look at those, and I'm not saying you necessarily want to jump in and chase them. It just tells you how healthy is this market, and will money be flowing into other parts of the market, other parts of the stock market? And the answer is yes. If you see these companies doing this, then the rest of the market will probably participate. For me personally, I am not chasing this stuff at all. Also Home Depot, MasterCard, and I just threw Tesla in here. Now this is a smaller company. It's big. It's $250 billion market cap, but it's not in the trillions like these other ones. And so I always just look at these, the Home Depots, the MasterCards, the Apples, look at them every day, see what they're doing. All right, that tells me that, all right, this market's probably going higher. Okay, let's look at some ETFs and stocks that you could invest in. So I'm just no particular order. What I like is I like the stuff that's still down, that could still increase in value versus chasing something. So jets, that's airlines. So if you're afraid of someone going bankrupt, and someone could, one of those companies could go bankrupt where you lose all your money if you buy the stock, maybe you just buy the ETF, jets, but I don't know how long it's going to take for this to recover. And if this thing starts breaking below this level, then I'm out. I do not want it to take out a new low. So just be prepared, and always be prepared to sell if something breaks below a major support level. It's the best way to protect most of your capital. You'll still take a large loss. It could be up to 20% or 15% or whatever, but you want to protect your capital. One of the airlines that probably would do the best and bounce back the fastest would be Love Southwest because it's local. All the long haul Deltas, Uniteds, Americans, they do a lot of international travel, and that stuff has just been completely turned off. So Southwest does not do a lot of international travel. It's mostly local, so they'll probably bounce back fastest. This is actually a good level right here. I'm going to add this maybe to one of our portfolios because I'm going to be right down at the support level. And I just want to make sure it holds over this support level. And if it does, then I will get in kind of down here, because then if it starts climbing and then if it fails, comes all the way back down and fails below it, I won't take too much of a loss. So I'm pretty much buying very low right at the bottom. Carnival Cruise Lines, be careful with these. Norwegian Cruise Lines, boy, it looks great. I mean, it'd be nice to get in here at 14 bucks, but I know they raise a lot of money, and they're able to hang in there for like a year, but they could go bankrupt. And if they do, then the stock is worthless. So I'm personally not touching the cruise lines. Oil, CVX is probably one of the better ones out there. We'll see. If you wanted to, you could just watch the 17. This is a weekly chart, so you could watch the 1743. Once that 17 starts getting over the 43, especially for Chevron, I'd probably want it over this level here, 112 bucks. And once it gets over that, then maybe it's investable. Cisco, largest distributor of food to restaurants. They just got killed. All the restaurants shut down, Cisco, and there's a few others. Now, this is one of the largest ones. Could these companies go bankrupt? Well, they could. There's risk in this, but I've bought it before. I held it. I got out of it. I might get back into it. This will be back up to here one of these days if it does not go bankrupt. Boeing, same situation. How long is it going to take for it to rebound? It's a good time to get in now. We're kind of down at this level, but you got to be really patient with this money. Very patient. It could take a while for Boeing, but sooner or later, Boeing is going to be back up to, it's going to be a $400 stock again. And they're not going to go out of business. The government will continue to bail them out. They have too many employees. We only have one large airline manufacturer. They can't go out of business. So the government will bail until they're finally running again. It's just, I don't know how long it's going to take for them to get back into a $400 stock. The banks, they're all hammered pretty hard. JP Morgan is one of the best out there. You could buy JPM. That's a good position to have. Could take a while for the banks to come back. Or you can buy the ETF, like here, KBE, the banks. So you don't have to worry about stock picking. But Citigroup, JP Morgan are all pretty good, especially JP Morgan, excellent bank. Restaurants, here's Darden. That one could bounce back if they don't go out of business. Olive Garden, I think Red Lobster, stuff like that. If anyone's going to survive, it's going to be these bigger companies, all the mom and pops. I think we're going to lose 30% of our restaurants. That's what I'm hearing, and I wouldn't be surprised. But the Dardens will probably survive. They can raise money. They can keep these companies on life support until coronavirus is gone. So this probably will be back to $125 stock someday, maybe a year. I don't know. Insurance, KIE. They're all hit pretty hard. That's another one that's I've looked at, and there's a couple insurance plays like Brown & Brown, BRO. That's a very good one. So, or you can buy just the ETF. That one should bounce back one of these days. IEV, Europe. It's over the 200-day line, and Europe, they got their virus under control faster than anyone, better than us. So that could be a good play. The resorts, gambling, MGM, I played around with this one. The risk is that, do they reorganize? Do they go, file for bankruptcy? Stock goes worthless before they get in. But boy, I am tempted. I got in, I got out of this one. I might get back in. I like where it's at down here at this level. And you just cross your fingers they don't go bankrupt. Wynn Resorts, same thing. So these will all pretty much double in value sometime once we get through the virus. Real estate, CBRE. This is a real estate company. They do services for real estate companies and real estate developers, and they've been hammered because no one's paying their rent. And this is a very good company. If you look at the weekly charts, most of these companies have grown nicely for the last decade. Ross Stores, TJ Maxx, Ross, Burlington Coat Factory. I mean, you can just see, I think this is a weekly chart, but one of these days, this is going to be back up here. And these have always been tough to get into. They've always been expensive. So you have to get them when they're down. Discount. Amazon can't impact them. They have a nice moat, kind of like Costco. Costco, Ross, you're not going to put these out of business. These companies will always be in play. They're a discounter. AON, oh, this is an insurance company here. So look at the growth. This is a weekly chart. Beautiful growth. One of these days, it'll be kind of back in this slope up here. Here's the bank one I showed you. KRE or KBE are the banks. Okay, so that's all I got on the charts. Those are just, no particular order, just my thoughts on certain industry sectors, certain charts. Industries that still are down and they could come back. Oh, I missed Hilton. So Hilton's in there, HLT. I guess I don't know what happened to it. So Marriott, Hilton, hotels. Hilton's one that I have in the big cap. So take a look at HLT, and that's a big player. Number one player, number two player, low probabilities of going bankrupt. They're the ones that will survive. And Starbucks, by the way, I mean, that, I had it, I made my 15%, I got out of it. I just think that I needed the technicals to look better on the chart. Excellent company, excellent brand. They're not going anywhere, but I know that their business is down about 40%, and it could be down like that for another 3, 4, 5, 6 months. All right, so questions to address. The Qs, NASDAQ, index, composites are all at new all-time highs. The small and the mid caps are showing some strength. How is this influencing the rest of the market? Well, especially when the smalls and the mids start participating, it will reinforce the uptrends. And so when that happens, you're like, whoa, whether you agree with it or not, this market wants to grind higher. So the SPX is probably going to get up to 3388 in days, within days. Like for for the Pinnacle strategy, I've been adjusting those and pushing them all up, because I know we're probably going up to 3388. So I got most of mine already up there. Now you just cross your fingers you don't have a crash or a 5% correction and that so quickly, but that probably the SPX is probably heading up to its all-time high. How expensive is this market? Very expensive. We're at almost 23 times earnings. That's just nuts. By the way, in 1999, 2000, before the crash, the dot-com crash, we hit 21 times earnings. 21 times earnings, and that was March of 2000. I think that's where we peaked, March, April, May of 2000. If the market sells off again, how low will it go and where will it find support? Here's the SPX. This is the daily chart. Here's the 50. Here's the 13. Here's the 200-day line. We're grinding up to 3388. We'll be back down if we really have a really nasty pullback, and we could, who knows, we'll be back down to 3000. 3025, we'll hold support pretty much right at the 200-day line. So for those who like to write spreads, like I do in Pinnacle, I'll be selling, well, you try to sell puts as close to this level as possible. You try to, or at least under this 50-day line, somewhere in that range, okay? What would be the best investment strategies for the balance of 2020? So passive buying of ETFs, stock picking, or non-directional option strategies. So for passive buying of the ETFs, I showed a few, like the banks or the insurance, those are still down, and you can still get into those, and you can still make 20, 30, 40% of those in about a year. That's my guess. And, or like jets, airlines, if you're afraid to stock pick, and you don't want to buy like a Southwest Airlines, you could buy jets. So I like those. I don't want to chase anything that has taken out higher highs, all-time highs. Stock picking, absolutely. I just showed a few kind of different sectors where stocks are still down. And if you want to start, buying some things that have just broken out to new highs, well, you can, and I'm thinking about it. But boy, if that thing breaks below its new high, I'm out, because everything is very overextended and everything is very expensive. Or trading strategies, and that's where Pinnacle comes in. Yes, you can always navigate and trade through a market like this. And the dividend income strategy, same thing. We don't really care what the market's doing. It can go up, it can go down. We're focusing in on the dividends. usually a basket of 5 companies that are throwing off 4%, 5% dividends, and then we lever them up, and then we buy hedges. So those make it easier. We don't have to guess what this market's doing. Should I sell some of my passive ETFs and stocks if this market continues to trend higher? Yeah, I don't want Apple anymore. I don't want Microsoft. I don't want any of those that have gone straight up. So I'm out. I've been out. Should I add short exposure to my portfolio? No, probably not a good idea. This trend is still wants to go higher, and I don't know how long it's going to last. And so we need the SPX to at least get up to its all-time high. It'll touch it. It'll probably hit resistance. It'll pull back, and it could stay choppy there for weeks, if not months, and maybe even never break out to a new high. Just don't know. Should I buy defensive stocks or ETFs? Well, I showed like gold and silver. Silver you could still look at. Gold, yikes. I mean, we're up to 2,000. I'm not touching it. But who knows? Who knows where it's going to go? I mean, maybe we'll be at $4,000 gold. I mean, we could, but because we did break out to all-time highs. So where do we go from now with gold? That's a good question. Now, one option is you buy above 2,000 and you make sure it stays above 2,000. Use those support and resistance lines, a lot. Use that support line, that 2,000. I think I would have to bring up the gold chart, but I forget exactly where it was. But let's just say it's 2,000. If gold stays above 2,000, stay in. If gold starts breaking below 2,000 and stays below 2,000 for 3 days, 4 days, start getting out. Just say get out and say, all right, I was wrong, and I'll take my 5% loss, and maybe gold's done and going higher. But if it stays above 2,000 and keeps on grinding higher, then just stay in anything over 2,000. Okay, so the next 5 slides are going to be on Pinnacle, and then I'm done. So Pinnacle is a conservative, non-directional income generating all-weather strategy. It's optimized and adapted for the new political era. It can handle the volatility that can come out of Washington, D.C., and that can sell off stocks at any time. It took me a year and a half to wrap my arms around Trump and this new era that we're in, trying to figure out how to navigate more volatility in the markets. And my goal is not to complain. Is just to adapt. That's my role, is to adapt and figure out what I have to do to adapt to whatever markets we have. And I figured it out, but it took a while. So we can generate positive monthly returns in upward trending, downward trending, or sideways and choppy markets. I hold a maximum of 3 to 4 positions at any one time, representing 30 to 40% exposure of the portfolio. Pre-Trump, I used to be at 70% exposure, even 80% exposure. Can no longer do that. We got tweets coming out every day. We have him talking in front of the helicopter every day. He can move the markets just about every day. So can't do that. So I cut my allocation way down, and then I bring in a little more premium for each trade, and then I have to be more nimble and I have to do more adjustments. But that's been part of the strategy all along. It's a different way of doing it, a little different way of doing it. I've been doing it for 18 years, and I like it. I like the approach that I've been taking now for the last 4 years or 3 years. So each position represents 10% of the portfolio. Open for 2 weeks, and recently the trades are open for 1 week because volatility is higher. So we hold enough cash in the accounts to make any adjustments necessary when volatility unexpectedly rises. That can happen at any time. So the strategy is conservative by construction, since it's 30 to 40% allocation, steady state, allows us to sleep well at night, and because we have a low level of exposure, but we're still able to generate some pretty nice gains. It's not too difficult to make a 5% gain, and right now through the balance of 2020, I bet it's going to be higher than that. It's going to be more closer to 7, 8 to 12% gain, at least through the end of the year. But I don't know, can't predict the future. I take it 1 month at a time. Targeted returns for the total portfolio is 3 to 5%. After commissions for the balance of 2020, the returns will be higher. Probably will be higher. Let me put that in there. Due to elevated volatility, capital preservation and safety are a top priority. and been doing this for about 17, actually 18 years. Okay, let's look at the risk reward graph. So we're going to talk about this risk reward graph. Let me just show this first. So this is an example of an underlying. This is the SPX index. I've sold some indexes. I sold some calls and puts against it. Here's the index as a function of time. So this is May through September. Here's the price of the index over here. SPX like a typical chart, okay? And then the blue line represents where the index closed on the day I took this snapshot. So it closed at 29.51. So this is an old chart. And for this particular trade, I sold a 3010 call. I bought a 3020 call for protection. I sold a 28.55 put. See where I said sell, bought, sell, buy. Sold a 28.55 put, bought a 28.45 put for protection. So these are spreads. This is a bull put spread. This is a bear call spread. Then you bring in premium. It's a credit trade. Here's the trade that I opened. This is the risk reward graph. Let's go to the next page. I think it's a bigger picture. Bigger picture. Risk reward graph. So everything to the right of this line is profit. Here's profit, $200, $400, $600 for the entire trade. This is a four-legged trade. And then everything to the left is losses. And here is where the index was when we opened up the trade at this line here, which was around 29.51. Then we sold a call, bought a call, sold a put, bought a put, and it creates this iron condor graph. And this is what it looks like at expiration. And right now we're doing 2 week in duration trades. Actually 1 week in duration trades. So in 1 week, this is where it ends up. And the index, this index over here, just needs to stay under this short call that you sold, and it needs to stay above the short put that you sold. And then as a function of time, let's say, hypothetically, let's say this trade has 14 days to expire. So on day 14, if you want to look at your profit and loss, you would run it off of this red line. And then as time progresses, it's pushing out to this black line, and this is what it looks like on expiration. And when you open up the trade, you bring in a credit, and that's what this represents. So this trade brought in $400 credit. It gets deposited into your account, but it's not yours yet. You don't keep it until expiration. So if the index over here stays below the short call that you sold and the short put that you sold over this 14-day period, then you keep the money. You'll keep this $400 credit. Okay, so that's how this trade works. Let me just summarize it. In this particular case, we sold a 29.55.45 bull put spread. So 29.55 is here, this level. 29.45 is here, and then it creates this graph. We sold the 3010, 3020 bear call spread. So we sold the 3010 here, sold the 3020 there. I'm sorry, sold and then bought there for protection. So this is a bear call spread on the top. This is a bull put spread on the bottom. You attach the two together, you get an iron condor. See, this one plus this one is an iron condor, and here's how you calculate the potential return. So the put spread brought in $130. So we sold that put and bought this put. It gave me $1.30 credit or $130 for quantity one. So quantity one takes $1,000. Broker will hold $1,000 of maintenance to open this trade. $130 comes in for the put spread. $170 came in for the credit spread, for the top call spread. Iron condor, you add the two up, so $300 credit came in. So the trade is basically $300 over $700 is what you're risking. That's your risk capital. $1,000 minus the $300 that came into the account. That's your risk capital. 700. Here's your potential return. 43% return in, let's say, 2 weeks. So for a 10K portfolio, you just opened up quantity one. So you only use $1,000 out of 10K, and you get a 3% return. I'll go up to 3 positions. And so, you can bring in 6, 9%, open up the trades once for maybe 2 weeks. And if you can keep that money for those 2 weeks for the whole month, you can just keep that money. That's a 9% return for the month. So typically each trade is 10% allocation. So now in this particular case, it's a higher credit. Usually I'm not bringing in that much of a credit. I'm usually bringing a little less, like $2.50 or $2. So instead of a 43% return, it's closer to more like a 30% return for that trade. This example is a higher credit because we have higher volatility. And I did take a picture of this when we had higher volatility. Okay. Yeah, Tovia mentioned, hey Tovia, crypto is flying high. Do you know, I looked at it just a couple days ago, but I don't look at it every day. And I'm not really a crypto guy, so unfortunately I can't offer much value on any of the crypto stuff. But yeah, if you want to send me an email, I'm at brad@upsideoptions.net. If you want to send me anything on what you're doing, or if you want me to look at some trades, I can. Okay, so for Pinnacle, it's looking good. It's finally back to work. It's back to normal. And I should be booking some pretty nice gains through the end of the year. And I got to catch up. I lost 4 months. I mean, I'm not going to artificially try to catch up. I mean, it is what it is. I'll do whatever I need to do. In normal situation, I do not artificially push the strategy. Capital preservation is much more important than anything else. So, you know, if I hit a 15% or 20% return this year, I'll be okay with it. But if I can hit my normal 25 to 30, 35%, I'll be happier. But it is what it is. I lost 4 months from the COVID crash. All right, so if you want us to do the heavy lifting, consider trying Pinnacle for free. You can go to the website and we do the analysis, we do all the trades, we open the trades, close the trades, no action is required by you if you auto trade, or if you want to learn the strategy yourself, I recommend doing it in parallel. Set up an auto trade account and then have your own account, and then in parallel do what we do, and then usually after about a year you can get pretty good at it. Okay, but at least auto trading, we do make a lot of adjustments and things can get fast moving. So just keep that in mind. Available strategies, we got the big cap, small cap, sector rotation contrarian, we got the iron condor pinnacle, which I just talked about, and then we have the leveraged dividend income. So if you want more information about that, just send me an email. And that is it. Okay. So if you guys have any questions, please let me know. And okay, someone's asking about KRE versus KBE. Okay, so KRE is, let me go to it. You have a couple ETFs that you can consider. And KRE is a bank ETF. Here's KBE here. And these are the larger banks, JP Morgan, Citibank, Bank of America. By the way, they're all great banks. Wells Fargo, be a little more careful with WFC. They've had lots of problems, but boy, you can make a lot of money. Someday Wells Fargo will be back. So if you really feel like you want to get in there and pick up Wells Fargo, you know, it'll probably come back one of these days. And I use Wells Fargo personally. All I know is I walk in, the bank's always packed. So they're not going anywhere. And I'm on the West Coast. JP Morgan's always a good fit. I mean, a good company, very well run. That's always a good play. Citibank, they're good too. They're global. It's just this pandemic has really hit them hard. And then KRE are regional banks. Those are smaller banks. The chart looks almost identical. If you look at this chart here, KBE versus KRE, they're very similar. The regionals sometimes will bounce back faster. It just depends. But right now the charts look identical. Okay. And then one question about returns for Pinnacle, why are they higher? Okay, so right now volatility, VIX is at 23, and that is elevated volatility. So VIX went from kind of a normal 12, 13, 14 pre-COVID, went straight up to 80, 90 range, which is just nuts. That's a very high level of volatility. Last time we've seen that volatility was in 2008, 2009. And then it's been coming down. I showed a chart of the VIX, and VIX is coming down. And with volatility at 22, it allows me to open iron condors that are wider. So some of my iron condors had almost 200 points between them, which is very, very, very wide. Now the iron condors I'm opening have about 100 points between them. So I can open up like a 33.80, 90 call spread, and I can open up a 31.60, 32.60, 50 put spread. Here, I'll bring up the SPX chart really fast so you can see what I'm talking about. So you can see where I'm at for strike prices right here. All right, so just FYI, 1 week trades, I'm opening up 33.80s. So I'm right up here, kind of 33.80, 90s. And then if, you know, those still could get hit. I'm always moving them around, so I might have to move them up 10 points, 20 points, just to get them completely out of the way. Because what we'll do is, when this, if this index does successfully come up and tag 33.88, and it probably will, probably within days, it'll overshoot just a touch. So I usually want a good 10, 15 point, 20 point buffer above this level. And then I'm at 32.50s-ish in that range. Now, it doesn't look like a lot, but it is. If you'd have to look at more of a daily chart with more details. This daily chart goes back like almost 2 years. So I'm opening up the 32.50 put and a 33.80 call. Okay, so that's, you know, more than 100 points between the short put that I sell and the short call that I sell. And so those are the iron condors, and they're only good for a week. 1 week, maybe 6, 7 trading days max. So with volatility higher, I'm able to bring in some pretty chunky premium, a nice, so I'm bringing in like $3, and that's kind of closer to that 40% return type of trade in 1 week. But I'm only opening 1 or 2 for a $10,000 account. So that'll bring in 3, 4% into the account for each one. You can get the account up to 7, 8% pretty fast, but now your goal is to keep that money. And so you have to be pretty nimble with these trades as this market bounces around. And it, you know, so we got Trump and his tweets and all his comments, and that could, you know, pull us back 1%, 2%, 3% pretty quick. And right now the market is climbing higher, it's trending higher. So the trend is our friend, and the trend is up right now until the SPX really touches 33.90. Okay, any other questions? All right, I think that is it. So if you guys have any other questions, just send me an email, and I'm at brad@upsideoptions.net or support@upsideoptions.net. Let me go to that page. And if you want to sign up for free trials of any of the strategies, please do. Okay. All right, well, thank you very much for your time, and I'll talk to you next time. Have a good day. Bye-bye.